Good morning, everyone. This is Jennifer Seedy, Assistant Director of Public Health Workforce Development at the University of New England. It's my pleasure to welcome you back to the series. Thank you for joining us today. So I'll just wait one more minute just to get everyone here online. I see that we do have 13 people joining us right now. Okay, so we are here at session 2. Thank you so much. So today we'll be talking about types of budgets and budget processes. Just so that you are aware, there are 2 handouts for you. You do have access to the PowerPoint presentation and a reference sheet. Please be sure to download those handouts prior to ending the webinar, because once we close the webinar, you will lose access to them. At the end of the series today, we will be launching our survey, and I just want to thank you all for participating in the survey that I sent a little bit afterwards and for answering those questions. Thank you so much for that. Also, remember that you can type your questions into the chat box or in the questions section. And when we transition into our Q&A portion of our session today, you can feel free to raise your hand and I will unmute you so that we can all hear your questions. This is our second time together, so no shyness allowed this time around. So seeing that we pretty much have all of the same attendees from last session, we're going to just delve right into today's content. Dr. Arsenault, thank you so much for coming back and welcome.
Thank you, Jennifer. It is a pleasure, and my thanks to all of you who participated in session 1. I very much appreciated your feedback and the fact that you took the time to give me that feedback. Today, we're going to be talking about budgets and budgeting. It is a lot to cover in a fairly short period of time, but we're going to give it our best today. Just a quick review for in terms of the purpose of this webinar. And the webinar is designed for public health professionals who have a limited knowledge of financial management and budgeting. We did learn 2 weeks ago at our first session that a number of you do have some experience. Several of you have some extensive experience. So I hope you found the first session helpful, and will find this one helpful as well. And the audience for this webinar are public health professionals, nurses, physicians, new healthcare managers in the world of public health, or individuals who may aspire to be in a leadership role in the future. So let's touch upon session 1 and what we covered. First of all, we looked at the importance of an organization's mission and vision and overall strategic planning process when considering the financial side of the organization and the financial future. We looked at the public health system in the United States. I guess I should say the public health systems across our country, because there are so many, and the various systems can be quite different region to region and state to state across the country. We identified sources of funds that support public health in our country, and we looked at examples of financial statements. Statement of financial position, which is often referred to as the balance sheet in a proprietary organization. We looked at an example of an organization's income statement or statement of operations for an organization. We spent a little time on the importance of an organization's finance department developing a cash flow statement and identifying cash flow needs for the organization on a go-forward basis. And we spend some time looking at terminology. And we'll be doing some more of that today. 2 weeks ago, I left you with a trivia question. I shared with you an experience I had I actually had an opportunity to speak by phone with Dr. Jonas Salk, which was a once in a lifetime thing. But I left you with a trivia question to think about. What is the name of the famous person who most impacted the acceptance of the Salk vaccine back in the 1950s and 1960s, to the point where immunization rates went from 0.6% to 80% in 6 months? And I'll talk more about that in a moment. So here's what we're going to have you do. Some of you may already know the answer, but in case you haven't had an opportunity to think about it, I've made a multiple choice quiz from the trivia question. So let me just touch upon that briefly. The first option is Dr. Albert Sabin, who actually developed the oral polio vaccine. The second option, Queen Elizabeth II, who became Queen of England in 1952, and she is still Queen of England today. Elvis Presley, who was a singer, entertainer in the 1950s, 60s, 70s. Ernest Hemingway, a famous writer, author, somewhat controversial during that window of time and controversial still today in terms of some of his writing. And Eleanor Roosevelt, the wife of the US President Franklin Delano Roosevelt, who actually was diagnosed with polio at age 39. I've put a little hint here for you as well. The hint is an event happened on October 28th, 1956, involving one of these famous people. And it was that event that drove the acceptance of the Salk vaccine in this country. So I think most of you have, I'm looking at the results here, and I believe we're going to.
I'll give us a second more because only 60% of people have voted. So
we'll give you
maybe we have some people on the
minutes.
fence there.
Okay, we'll give you another 30 seconds and then we'll share the results with you and then we'll share the answer.
Looks like we have 100% of you voted. So let's see. Great. So we have 43% of you said Eleanor Roosevelt, 43% of you said Elvis Presley, 7% Dr. Sabin, and 7% Ernest Hemingway. Interesting.
Interesting results. So we're going to go right to the answer. Just hang on a moment and the answer is forthcoming.
Hey kids, can I talk to you for about 30 seconds? This is Elvis Presley. If you believe polio is beaten, I ask you to listen.
So I just need a moment here just to switch back over to the PowerPoint. Just bear with me. say that again. So let's try this again. I'm sorry about that.
Hey, kids, can I talk to you for about 30 seconds? This is Elvis Presley. If you believe polio is beaten, I ask you to listen.
Remember me.
Now, that's the voice of thousands who know the fight against polio is just as tough as it ever was. They're crippled, and the Salk vaccine can't help them recover. But you can. Remember polio victims. Join the 1957 March of Dimes today.
Elvis Presley, the king of rock and roll, and part of a remarkable campaign that would see an end to a disease that was ravaging the youth of 1950s America.
Well, thank you. Half of you got the answer right. It is an interesting trivia question in, I think, the world of public health, because it demonstrates so much about how to mobilize resources in the community when there is a public health situation. At the time, parents were actually doing pretty well getting their young children immunized, even though there were some barriers to immunization. But it was the teen population that thought first they were not at risk, and secondly, there was hesitation by teens to be immunized. And so on October 28th, 1956, Elvis Presley was rehearsing for his soon-to-be premiere on The Ed Sullivan Show. Some of you may have heard of that show from the 50s and 60s. And the March of Dimes worked with him and his representatives that he would go on live TV, ABC specifically, and receive his first immunization with the Salk vaccine. And within 6 months, the teen population in this country went from being immunized under 1% to over 80% in that short period of time. So it's a great historical piece of trivia, and one I think that has some applicability today as we think about some of our public health issues. But let's get back to the topic at hand, and that is our learning objectives today, which is to examine the importance and develop a beginning knowledge about budgets and budgeting, and deal with some of the terminology related to budgets and budgeting, and differentiate among the various types of budgets that are applicable in a public health setting. It probably goes without saying that we cannot do justice to the topic of budgets and budgeting in the hour and 15 minutes we have left this morning. I couldn't resist putting a picture of my grandson in here, because he says to me all the time, "Nana, you can do anything." Well, this morning I will do my best in getting through some high-level material when it comes to budgets and budgeting. So I can't do everything, but I will do my very best. So let's start with, what is a budget? A budget is a time-limited plan that is expressed in numerical terms. It is from the French word bouchette, which means a little leather bag or a little leather pouch. And in the history of early France, people carried their entire wealth in a little leather pouch, usually on their belt. And it was from that little leather pouch that all of their needs were met, food and clothing and so forth. And so that was their budget, if you will. And so that's the history of the word. A budget is expressed in dollars. And I say dollars purposefully because you will not see budgets expressed in dollars and cents very often. It's sort of like filling out your income tax every year. You fill out the IRS forms and you don't put down the cents, you just put down the dollars. And often budgets are accompanied by a narrative with assumptions about the particular budget. A budget outlines the intentions and the expectations of an organization or a department or a program within a one-year window of time. It identifies revenues that are coming in to the organization or to a program and expenses that you anticipate will be incurred during the upcoming year. A budget is also a communication tool. It lets everybody talk about what are the resources that we anticipate having over the upcoming year and what are the expenses we expect to incur. It is also a mechanism to begin examining a particular organization, a program, a department for possible inefficiencies and waste that may occur. And the budgeting process in an organization can ferret out some of those inefficiencies and opportunities for process improvement. Budgeting is a process. Think about a budget as a piece of paper or a computer software system. Budgeting is a process. It involves a lot of communication throughout the organization. It is an opportunity for people in the organization to talk about their needs in the delivery of services to patients, clients, the community. It's also a mechanism for people to put forth their wants as well. It involves negotiation and mediation among departments, among programs, among and between people in an organization. It is also an iterative process, and I think that is critically important to talk about. I know I've been in organizations where it seemed as if the budgeting process never ended, because it didn't. It would go on for a lengthy period of time, and even once the budget was settled, we were still budgeting. We were still looking at, have new assumptions arisen that we didn't anticipate through the budgeting process? What has changed in the environment that has caught us off guard, by way of example? The iterative process of budgeting involves cycles of analysis, decision-making, and approvals. So what I've tried to capture on this slide is the variety of individuals and positions and organizations that are often involved in the budgeting process. First, for a not-for-profit organization, it is very common for the Board of Trustees, the Board of Directors, to set the goals and direction for the budgeting process. Or if your public health organization is part of a municipality, it may be the city council that drives that oversight process. State legislatures often drive the budgeting process, particularly for a Department of Health and Human Services. And of course, if you are working with grant funds, the grantor may also set parameters about the budget and the budgeting process that has to be considered for a particular grant. In organizations, there's almost always an oversight structure for the budgeting process. The Chief Executive Officer, the CFO, the Chief Clinical Officer in an organization, the Finance Committee Chairperson, whether it is a not-for-profit organization or a municipality. The mayor or the city manager may offer for a municipality that oversight structure. Or your state Department of Health and Human Services may be very hands-on with the budgeting process when it comes to state funds or pass-through funds from the federal government. And again, your source of grant funds is often very involved in setting forth expectations in the budgeting process. For department managers, it is not uncommon that the launching of a budgeting process starts with some very specific financial objectives. For example, an organization has done due diligence, often the finance individuals in an organization, and have determined they do not expect an increase in revenue. That is particularly true if your money is coming from a municipality. Perhaps you were allocated $250,000 last year. That was your city's allocation for public health. That was it. This year, you've already been told there will be $250,000. That's your allocation. And now it is, how do you carry out the budgeting process to back into that number by way of example? An organization may also set parameters about expectations about budget reductions. For example, the dreaded words that we all don't want to hear. You have to make a 5% reduction in your personnel costs for next year because we are not being paid at the level we were last year, or our allocation that is coming from our local municipality, the county, the state, is going down by 4%. Department managers can also expect to work with a budget calendar with very specific target dates, and we'll talk a little bit more about that in just a few minutes. This is a little difficult to read, this graphic, but I thought it was particularly interesting because it outlines in detail the county budgeting process for the state of California. And this is only a year ago, so it's fairly current. And if you look at the top center of this graphic and can read any of those words, the governor in the state of California proposes the state budget, and at that particular point, the budget is fairly set. And then the process begins at the various county levels in the state of California. How money will be allocated for various functions throughout the many counties in the state of California. And what happens in January, February through April, May, and so forth. And I can guarantee you that with this particular graphic, the state of California probably has a budget binder that is many inches thick that guides each and every county and every program that receives state funds as to not only the process they have to use for determining departmental budgets, but what is allowed and what is not allowed in those various budgets. I think it goes without saying that any organization launching into the budget process is going to experience divergent budget goals. An organization is going to want to look at as low salary costs as possible, keeping the costs of benefits down, particularly as benefit costs skyrocket, having a smaller staff versus a larger one, and having low support resources, but of course adequate to get the work done. However, individuals in the organization are going to have some pretty different expectations or wants. We all want our salaries to be higher. We want our benefit packages to expand. We want more staff to work along beside us to get the work done or be able to do more in the community. And if we can have more extensive support resources, then it frees us up as public health professionals to do more in the community. So recognizing those divergent goals, one of the most important aspects of starting the budget process or launching the budget process, from my experience, has been how do you bring the organization and individuals in the organization together to understand what is motivating us mutually. First of all, we want to serve our patients, our clients, and the community. And staff who work in public health have that goal as well. We want to see our organization not only survive, but thrive. Remember 2 weeks ago, we talked about if an organization doesn't have a financial margin, they cannot accomplish their mission because the organization will not be able to successfully survive and thrive. Organizations and individuals in organizations want to be an employer of choice. We'll talk in a little bit about costs related to turnover in healthcare today. It is a critical issue, and we have a crisis almost before us in healthcare because there are so many of us who are retiring. And so when it comes to providing professionals to meet healthcare demands and fill roles, being an employer of choice is critically important, and it's important to have that as a goal that both the organizations and individuals in an organization can rally around in terms of the budgeting process. And a recognition that there are some goals and needs and wants that are just unrealistic. The staffing in your department is not going to double next year. Everyone is not going to get a 6% raise. We're not going to be able to pay for more of employees' health insurance benefits. And you know the list, you deal with it every day in public health. But to have these discussions up front, to involve people in the organization in talking about the motivation, if you will, is very important as you launch the budget process. There should be nothing secret about the fact that the expectation is there will be no added revenue next year. And here's why. That should be an open, transparent communication throughout the organization. Or, yes, we are going to be introducing a new program next year, and there will be revenue new to the organization to launch that new program. But it will be for that new program, not for existing programs. So let me talk about the differences that can be seen in organizations when it comes to the budgeting process. One of the things we talked about 2 weeks ago is there are some budget processes that are totally top-down. As a department manager, for those of you who are in that particular role, you may be allocated a particular amount of money from your county government, from the State Department of Health and Human Services, and that is all the money there is. And you are also mandated as to how you will spend that money. That is a top-down budgeting approach. Your involvement as a department manager in terms of, excuse me, how those dollars will be allocated, you may have minimal or no involvement. It's preset for you. It doesn't mean it's bad. It is a model that often happens for a fixed department, particularly when it comes to state, county, or local governmental agencies. And then there is what I call the bottom-up budget participation approach. It is a model where not only are managers, department and program managers and coordinators involved in budget preparation, but staff at the departmental level are also involved in that process. So let's switch gears just a bit and begin talking about the types of budgets and approaches to budgeting. I want to start with approaches. 2 weeks ago, we talked about the zero-based budgeting approach. Those of you who work with grants at one point developed a grant proposal and included in that proposal a zero-based budget. You started with a blank piece of paper and you built your program and put the financial requirements and parameters to that particular program. That's zero-based budgeting. Another approach is incremental, and that can be either top-down or bottom-up. And for the rest of our time together this morning, I'm going to talk about an incremental budget approach, bottom-up, from the department up, essentially developing an organization's master budget from that approach. And the last approach is a performance budget. And I will end my remarks this morning by talking about that briefly and what that means. But let's go back and talk about the types of budgets. We talked about it a couple of weeks ago. Every organization has a master budget. It is the snapshot of the entire organization, and it's called the master budget. And included in that master budget is the operating budget, which are the revenues and expenses from the work that you do. There is the capital budget, and that is about buying equipment. The statistical budget that we touched upon, again, a couple of weeks ago, and the cash budget that is prepared and projected by the finance folks in your particular organization. Let's start with some basic budget terminology. I had a little bit of a hard time deciding what to talk about because there are literally hundreds of words in budget terminology, but I wanted to touch upon just the ones I think that are the most important given our time today. You know, I found this graphic which outlines all of the terminology related to a sailboat. I am not a sailor, but perhaps some of you are. And a budget terminology is somewhat like this sailboat. So I thought it was applicable. I know if I went on a sailboat and the person piloting that boat began to use all of this terminology, I would be somewhat lost. For sure, I would be quite lost because the terminology is very specific to sailing a boat. And so I think that budget terminology is that way as well. And the more we can learn the terminology and how to apply it, I think the more comfortable we will feel as non-financial managers in the world of the provision of healthcare services and specifically public health services. So let's start with the terminology, the term fiscal year. Organizations have a fiscal year. It is most common either January, July, October. And we touched upon this briefly a couple of weeks ago. Many private organizations, let's say that we were a for-profit wellness center, we most likely would have a January fiscal year. We would start our books, our financial records would show that January was the beginning of our fiscal year. For a lot of not-for-profit organizations, July is the beginning of a fiscal year. And often, if not exclusively, governmental organizations, whether it is federal, state, county, local municipalities, almost always have an October 1 fiscal year. And that is because the federal government starts its fiscal year October 1. I was involved with an organization not that many years ago that changed its fiscal year from July 1 to October 1. And it was quite a process to go through. And there was an important rationale why that happened. But the fiscal year is an important time frame in considering the finances of an organization. In an organization, there are apt to be numerous cost centers or responsibility centers. Those are interchangeable terms. A cost center is a department or a program within an organization. Now, sometimes an organization just has a dozen responsibility centers. It could be that for a municipality, a cost center is dedicated to administrative functions. Another cost center could be the public health department. An additional cost center could be the maintenance department of that municipality. In a hospital, by way of another example, there are several dozen cost centers. Think about all of the departments and programs in a hospital. Each one of those departments or programs are called a cost center or responsibility center. So when you walk down the hallway and you have a question for the chief financial officer or your lead accountant in your organization, that individual, if you are in a large organization with a lot of cost centers, they're going to say, well, tell me what cost center you want to talk about. And so important as you develop those responsibilities, because a manager or a director in an organization may be responsible for several cost centers. And it's important that costs are kept separate between various cost or responsibility centers. And then each of those cost or responsibility centers are identified as either an expense center or a revenue center or both. So let me give you an example of what the difference might be. Again, I'm going to use the example of a hospital because I think it makes the difference pretty clear. If I am responsible for a housekeeping department, environmental services in a hospital, I am a pure expense center. My housekeeping staff carry out no work that's going to generate revenue for the organization. But if I am the manager of the laboratory in my hospital or the radiology department, I have to worry about the revenue I will be generating for the organization. And so you will often see financial reports that say expense center housekeeping, expense and revenue center laboratory. And that's why you'll see that terminology to identify that this particular program or department, cost center, is only an expense center. Within departmental budgets, there are line items. Those are, and I'll show you some examples in a couple of minutes. Those are very specific items that are categorized in a budget. For example, most budgets have a line item called office supplies. That's a line item. Most budgets have a line item, medical supplies, if you are in any way delivering medical services, or a line item for photocopying or conferences or travel. All of those items that you may be used to seeing are called line items, and they have numbers. And again, I'll give you an example so that you can see how you can identify in a cost center's budget, a particular line item may show up as being over budget or under budget. And that will be something we'll talk about in a couple of weeks when we examine how you will carry out a variance analysis when your budget may be over or under and why. And then the budgeting process can either be fixed or variable. I want you to remember that for a moment, because we will be looking at in a couple of slides the difference between a fixed approach to budgeting and a variable approach. In a couple of weeks, we will talk about variances. And the terminology you will hear when working with budgets, a variance is either favorable or unfavorable. A favorable variance means that you have met budget for that particular line item, or unfavorable, you have gone over budget. And in financial statements, the way you know if it is an unfavorable variance, in other words, whoops, you didn't meet the budget that month for your office supplies, you will see the numbers in parentheses, brackets. Finance people call them brackets, not parentheses. And the variance analysis process is to try to figure out, why am I under budget? Because knowing why you're under budget is just as important as knowing why you're over budget. You'll hear that terminology as well, over budget, under budget. But more often you will hear favorable or unfavorable. In a couple of weeks, we'll also talk about materiality, another term. And that essentially means, is the variance significant enough to worry about it? Now, if we have finance people on the line, you're probably chuckling right now, but that's how I see it. If I have a very large budget and I have budgeted monthly $35,000 for medical supplies, and this particular month I was over $102, that really isn't material. Now, if that continues every month, I might take a look at it. Most organizations have a percentage over or under to determine what is material when it comes to budget variance analysis. And again, we'll look at that in depth in a couple of weeks. And then terminology related to what is indirect versus direct cost. Many programs have direct costs related to staffing, supplies in your department, benefits that are provided to employees. But you are also allocated overhead costs. Who pays for the building that you're in? You may be allocated based on the size of your program, the square footage that you use, a certain amount every month. And you look at that and say, look at the cost of our office space. How can it be that high? That's an indirect cost, but somebody has to pay for it, and it has to be fairly shared throughout the organization. And then lastly, productive versus non-productive time. Productive time is when someone is working. Non-productive time is when an employee is off, going to a conference, is not available to work. Some organizations categorize time that an individual is off due to a work-related injury as non-productive time. So again, when you prepare your budget, not only do you have to plan staffing for when someone is working, but you need to worry about when they're not working and still being paid. So what happens when you're ready to launch into a budgeting process in your organization? I am certain that there is a budget calendar. Everyone has to work with a timetable or budget calendar, and here's one that I think is pretty straightforward. It is allowing 17 weeks for the preparation of this particular budget. For some organizations, this might feel like a pretty lengthy period of time. For other organizations, it's pretty short. I have been involved in budgets and budgeting my whole career, and it is almost always a 4-month process from the very beginning to the very end. So you're only a little more than halfway through your current year, and you're already looking ahead to what's going to happen next year. And there are challenges with that. I think we would all agree. How do I know what's going to happen 14, 15 months out? But that's where projections and analysis is so critically important in preparing your budget. So let's just take a look at this. Obviously, this particular budget timetable is launched by the chief executive of the organization. And notice that the chief executive or the leader of the organization, the city manager, if you work for a municipality, will identify some objectives and parameters. Often up front, determination is made as to will there be salary increases next year? If so, how much for which job categories? It can get very complicated because you may not know that as you launch into the budget process, particularly if you are in an organization that is unionized, which many municipal workers work in a union environment, and perhaps the union contract has not yet been negotiated. And so there are times when issues around salary increases are determined near the end of the budget process. And then quite frankly, the budget has to be recalculated with that new information. The other information that can be very, very challenging in starting a budget is when there are unknowns about certain other significant expenses. I can remember a time in the state of Maine, and some of you are in Maine, when there was absolutely no way to accurately predict what the cost of fuel oil was going to be for the upcoming winter. Now, the cost of fuel oil has settled down over the last several years, and we all hope it stays that way. But for a hospital that uses a significant amount of fuel oil for heating, to try to predict that number, to put it into the budget, was a huge challenge. And there are other examples. The cost of pharmaceuticals. If you are sponsoring a clinic where pharmaceuticals are used, the cost of pharmaceuticals is truly a moving target for most healthcare organizations. And so this timetable outlines how guidelines are provided to department managers for both the operating and the capital budgets, and we'll get to both of those in a minute, all the way down through how the review is going to be done. You will note here that this organization has a capital review committee, and we'll talk about that in a moment as well. Most organizations have a final step of approval, whether it's the organization's board of directors, whether it is the city council, if you work for a municipality, or some other oversight entity. Remember my previous slide, someone has oversight for the budget process. It must come back to that oversight group or responsible body for final approval. So let's start with the statistical budget. Most organizations deal with some statistics in planning the services you will deliver in the upcoming year. If you sponsor a prenatal clinic, how many visits do you anticipate you will do next year in that prenatal clinic? You will base that on your current clinic volume and maybe new information you have. Perhaps a private obstetrical provider in the community has just retired. And so you anticipate that your prenatal clinic will see more patients because of the lack of access in the community. And so in the budgeting process, you must make some attempt to project and predict what that new clinic volume may be. Client encounters in the community. If you sponsor a diabetic education program, how many encounters do you anticipate? How many have you had? And how many are you going to plan for next year? If you provide other educational programs, nutrition programs, healthy behavior programs in the local school systems, all of those involve hours of work. They involve workload. We think about that from, I guess, an industrial point of view, but it applies to all of the work we do. It takes people to do this work. And how do you determine what the work is so you can plan how many people you need for the upcoming year to do that work? There are public health departments, and perhaps some of you are part of public health departments that actually have laboratories as part of your county health department. Predicting laboratory tests and how much work is involved is actually pretty easy to do, because laboratory testing takes a certain amount of time. If you have a certain volume of various types of laboratory testing, then you need a certain number of people to run those tests. These are all examples of the statistical budget that you will plan ahead of time. Obviously, for a hospital, how many emergency department visits do you expect? How many radiology studies do you think your hospital will do? Admissions to that hospital and so forth. The important point with the statistical budget, unless you have a set allocation from your county government, or if you are working with 4 grant funds that tell you exactly how you will expend those funds, you really need to examine your statistical budget before you start putting dollars to a budget. There are 2 approaches to looking at your workload statistics. One is called a fixed approach. The other is called a variable approach. The first approach is, here are the staff you have to do the work, and that's all there is, and that's what you're going to budget for. And if you've got 2 nurse practitioners in your clinic, The 2 nurse practitioners will do what they can do, but that's all there is for resources. The second approach is a variable approach. If you do more clinic visits, then you need to introduce more time of a nurse practitioner, of a clerical person in that particular outreach clinic, and so forth. So let me give you an example. If you are preparing, if your organization only deals with a fixed budget approach, then let's look at the middle column for this clinic. 4,000 visits a month is what is predicted. Busy clinic, big clinic, lots of patients coming, lots of providers you can see based on the salaries. And so the way you would prepare the budget for this clinic is to say, our best estimation is we will do 4,000 visits a month. And here's what we expect for revenue, $165,000 per month. Here are our staff salaries, supplies, the rent for our building, and so forth. And with those 4,000 visits, we think we'll make just a little bit of money every month, a couple of $1,000s. That's your budget. If your visit volume varies, then you explain that each month through the variance process. Let's say you only did 3,600 visits last month. Well, the first thing that happened, your revenue went down quite a bit. You didn't see as many clinic visits. You weren't paid as much by insurance companies or private fees. Your staffing stayed just about the same. Your medical supply costs went down a little, but when all was said and done, you lost money. Remember, brackets mean unfavorable. Brackets mean you didn't meet your budget. But if you did 4,400 visits last month, again, you can look at the scenario, you make more money on the bottom line. There are flexible budgeting approaches that are used by some organizations that automatically adjust your budget based on the volume of work you did. You don't have to worry about it from a budget variance point of view, because all of a sudden, if you do 4,400 visits in the month when you predicted 4,000, then your budget will be adjusted for the added costs because you had added revenue. Now, these are pretty sophisticated budget systems that will flex budgets based on volume of activity. They tend to be more difficult to put together. But for a department manager or a program director, it can be a really good system because it accommodates workloads that are variable, like clinic visits, like laboratory visits. The last time we met, we talked about the importance of a cash budget. Remember, another type of budget. And this is a function of the finance department. Department managers otherwise really don't have a lot to do with the cash budget, but someone in the organization needs to make sure there's enough cash, money in the bank, to meet payroll, purchase supplies, and so forth. And if there are going to be cash shortfalls at some point throughout the year, is there a need to set up a short-term line of credit for that organization so you can borrow until the next revenue comes in, particularly when you're dealing with insurance companies. It can also apply to an organization that receives grant funds 3 times a year. Well, that's good, but think about what that means when you're trying to meet payroll every 2 weeks and your grant funds only come in 3 times a year. That's a great example of why the finance people worry about and focus so much on the cash budget and cash forecasting, because you have to pay people their salaries and you have to pay your bills. The cash budget, another type of budget. So let's talk about the operating budget. This is the big one that we all pull our hair out on sometimes. And how do you put it together? You've worked out your statistics for your particular department or your program. And now you have to figure out how much money you have coming in. Let's assume you are a department that is a revenue source as well as expense. All your sources of funds, and those can be allocations from the county, fees from insurance companies, grant dollars. And then you need to look at the volume of work that you expect you will be doing in relation to those fees. Now that sounds pretty straightforward until variables are thrown in. Let's say next year you anticipate, because of contract negotiations, that and I'll randomly pick an insurance company. So I have no ill will against, let's say United as an insurance company has already said, we are reducing our payments starting October 1 by 2%. And so if you sponsor an outpatient clinic and you have a number of your patients who are covered by United Insurance, you're not going to generate the same fees through that billing of insurance companies that you did during the current year or last year. Perhaps in your state, the Medicaid program decides they're going to cut back 6% on the fees that they'll pay you for a prenatal clinic visit. Now, that would never happen, right? Well, it happens just about every year for most states with Medicaid dollars dwindling. And so not only do you have to worry about the volume of clinic visits or laboratory tests, you need to look at what will we get paid for that activity next year, particularly if you're doing it on a fee-for-service basis. And that can be very tricky to figure that out. And then all of the expenses that you have to worry about, personnel costs being probably the biggest one. And that is related to salaries as well as benefits. Now, almost always an organization has their benefit costs calculated centrally, and then it is distributed, if you will, throughout the budgets based on what the anticipated costs will be for those benefits. Health insurance being a big one. What will be the contribution rate for the retirement plan is another one. The supplies you use in your department, equipment, conferences that your staff will go to, you purchase books, journals, routine travel costs. If you pay your staff to go out to community sites to deliver services, then you will be reimbursing them for their mileage, another cost that goes into the operating budget. Here's an example of a budget. This one's all prepared. It is outlined month to month. This example is a clinical education department. I thought it was a good one because it doesn't generate revenue. Your clinical education department, although you may charge some fees from some educational programs, but this particular education department doesn't have any revenue, all expenses, and they have personnel, so those are salary costs. It could also include benefit costs in that line. We don't know that by looking at this particular report. It has allocated overhead costs, which everybody looks at and cringes. You mean I have to pay for some of the heat? My department, well, we don't keep the heat on very much, so why are we being allocated that much? But somebody has to pay those bills. Your office and printing supplies, and then clerical supplies. Obviously, this particular department has a lot of supply costs because it's an education department. So this is an example of a budget once it's been all put together. Now, if we're using this as the current budget for the education department, it's a great starting point because the department manager will know where he or she stands with each of these. And we'll look at an example in a moment about budget versus actual. And let's do that right now. This is a general surgery department budget and monthly report. It is budget and actual. So I'll have you look to the left. For the current month, this month, which means the month that just ended, let's say it was September, what actually happened in this general surgery department? Obviously a hospital. And you can see the revenue is at the top of this sheet, then the salary expenses, then the supply expenses, and then interdepartmental expenses, which are those expenses that are more the allocated costs. So this general surgery department has been assigned a cost number, a responsibility number. This organization uses the terminology responsibility center. It is 611. These numbers come out of what is called a chart of accounts. These numbers are assigned by the organization. And then if you look down in the center of the page, you'll see some more numbers. Next to regular salaries, you'll see 010. That is the line item number. So if I'm going to see my chief financial officer because I have a question about equipment rental, because I didn't think I was renting any equipment, the chief financial officer is going to say, which responsibility center are you talking about? I'm going to say 611. And what line item? And for equipment rental, we have here 080. Again, it's part of speaking the language of finance. You'll get a much, I think, quicker response if you say, I have a question about responsibility center 611, line item 080, because that's the world finance folks live in. It is often the case that an organization will start with the current budget. Now that may feel top down, but it really isn't. This is an example of a snapshot of where the general surgery department is for 7 months. And so now the department manager will begin the projection process of what is my department going to look like next year. And we don't have time today to look at all of the various tools that are used to come up with those calculations. But I can tell you that there are many, many worksheets that are used to project these various line items. Revenue projections, we've already touched upon that, so I think I'm going to skip over this, but it is how do you look at what money you expect to have coming in as you're putting together your operating budget. It is revenues and it's expenses. Here's an interesting graphic. If you work in an organization, obviously this happens to be an example from a hospital. The volume projections for your particular area of responsibility, let's say you are a nurse manager for orthopedics. As you project your volumes, those volumes of orthopedic patients that are coming in for either a hip replacement or a knee replacement are going to drive other volumes in the organization so that there is this interrelationship And it is critically important that there is communication between and among program directors and managers in hospitals when it comes to predicting the surgical volume that will be done next year. This example happens to be orthopedics and cardiac. But if I, as that department manager, are predicting a 7% increase in my surgical orthopedic volume next year, but the radiology department has no increase planned, there is a disconnect, because orthopedic patients are going to have radiological procedures. And so through the budgeting process, in this scenario, there needs to be a relationship, a mathematical relationship demonstrated between one part of the hospital projecting an increase and how it's going to cause that same increase percentage-wise in another department of the hospital. I just thought it was an interesting way to demonstrate that interrelationship. One of the most difficult areas, I think, to work through are the personnel expenses for any organization when you're dealing with the budgeting process. Now, if you have 2 or 3 people in your department, it's pretty straightforward. You know people's salaries today, you know how many hours a week they work. Pretty easy to project for next year. But when you have 80 people in your department working full-time, part-time, they may work some evenings, nights, weekends, depending upon programs. They have both productive and non-productive time. They're allotted so much time per year for conference time, in-services, monthly staff meetings. All of that has to be factored in, and worksheets are used, detailed worksheets, to not only identify individual people, but the hours they work, what their hourly rates of pay are, and what the total base salary will be. Now, if you were preparing a budget for a hospital department, you would have a worksheet for part-time people, a worksheet for full-time people. You would have worksheets to calculate differential pay for people working evenings, nights, and weekends. You would project what you think your turnover is going to be, which is very, very challenging, because every time a staff person turns over in your department, whether you have a small program or a large department, it costs money. It costs recruitment costs. A new individual joining your organization is not going to be as productive for a window of time and will require training. You may have to use a contracted employee for 2 months while you hire a new person or new people. That can be more expensive than hiring someone and having them go on your regular payroll. And then there are numerous non-personnel, non-capital expenses, and I want you to hold the non-capital in your mind. Everything from office supplies, minor equipment. We've talked about rent, utilities, conference travel. If you provide a clinical service, you have to worry about linen and laundry for your outpatient clinic, as an example. All of these have to be projected line item by line item. Some organizations have a narrative component to the budget process, where a department director, department manager writes down particular assumptions. Now, if that has not been part of the budget process you may be familiar with, I always think it is a very good idea. And share those assumptions with your boss, with the chief financial officer. For example, what are you anticipating in terms of staff turnover? 1 staff person, 3 staff people, nobody? Because all of a sudden, if it's very, very different, you can go back and say, I anticipated that I'd only have 1 person leaving the department, and I have now had 5. And that's why my costs in these areas are so different. An example that often comes up in an organization where there is extensive use of volunteers. Volunteers work really, really well until there are no volunteers. And you have to have someone carrying out a particular function, so you have to hire someone, either permanently or temporarily, to fill that particular function. So if you have as one of your assumptions that the front receptionist area for your outpatient clinic will all be volunteer time, and suddenly that changes, it's really good to be able to go back and look at your narrative assumptions about that particular issue. And obviously, there are many other examples that we could look at. And then there is the capital budget. The capital budget is for long-term investments, an item that is expected to last more than a year or more than 2 years. And every organization has a capital threshold or capital cutoff. And it can vary widely. It can be $500. It can be $50,000. Now that's pretty rare in healthcare. But first and most importantly, your organization will communicate as part of the budgeting process what is the capital threshold. And items such as patient exam tables, radiology equipment, depending upon the capital cutoff, it could be a desk, it could be a large conference table. That if your capital cutoff is $500 and the table is $700, the capital budget is handled separately in most organizations. And there's usually a committee that reviews capital requests. This is particularly true for organizations that have a lot of capital needs. And again, probably the best example is a hospital. Capital assets also have to be tracked. I will tell you there's nothing more frustrating to know that 2 years ago, a particular department ordered a $5,000 piece of equipment and now nobody can find it. It's on the capital asset list and it is gone. And that's a story, I think, for another day. But capital items are tracked. I pull this from the Government Finance Officers website. It's an association of governmental financial officers, and it is guidelines for recommendations for both state and local governmental agencies when it comes to the handling of capital assets. And I don't know what it is in the organizations that we have represented here today in terms of capital cutoff. But from this association point of view, they mention the $5,000 cutoff. So maybe we can talk more about that in our question and answers. I'm not going to go into too much detail, but part of the capital process is that you as a department manager or director will fill out a capital form and talk about the cost of the item and what's the payback. What is this item? Is it something you are going to bill insurance companies to use? Or is it a piece of equipment that really will have no return on investment? It is just a patient care item that you need to have. And everything we've talked about is rolled up into what is called the organization's master budget. And in addition, the finance people for that organization have to worry about things like, does the organization have debt obligations? Has money been borrowed in the past to build a building? Are there interest payments that have to be made on that borrowing? That has to be put into the master budget. And then a whole category that we don't have a lot of time to talk about today. But just because you bill an insurance company for prenatal visits and you bill the insurance company, let's say $75, the chances are they're going to pay you less than that and maybe quite a bit less. And the difference between what you charge for your services and what an insurance company will pay is called a contractual allowance. And it has to be reflected on the books of a healthcare or healthcare related organization. And then most organizations provide a level of charity care. And that is almost always provided based on a sliding fee scale, individual clients' incomes, and so forth. And then the category of bad debt. It is considered an expense for an organization, and it has to be planned for in terms of the budget, has to be reflected in the financial statements. Bad debt is when an individual is expected to pay for their clinic visit because they have financially not qualified for charity care, but they then do not pay their bill. That category is called charity care. And I will very quickly cover this because I'm mindful of our time. There's a whole movement, I think, in the world of healthcare to do performance budgeting that is quantifiable as part of the budgeting process. So you may hear that term, performance budgeting. And it is to set benchmarks for a department, for a program, for quality improvement initiatives, improve customer and client and community satisfaction, increase productivity, certain cost controls that are put in place, and staff satisfaction measures, increasing staff morale. I mentioned cost controls. There are organizations who may have a goal of increase or decreasing by X% things being stolen from the organization to drive down costs. So let's summarize today. We've looked at the importance of budgets and budgeting in the world of healthcare and public health. Hopefully, I've given you just some beginning understanding of budget terminology, as well as differentiating among the various types of budgets. And don't forget, October 17th, 2 weeks from now, and you will get a reminder, we will be talking about performance management, and I'll talk more about performance budgeting at that time. How do you have performance measures that you can actually budget? And we'll talk about budget variance analysis and specific strategies for corrective action plans when we need to get our budgets back in line. So I'm going to take a breath. We'll go and start the process of answering any questions that you might have. We only have a few minutes today. If we have more questions than what we can get to, we can hold 2 or 3 of the questions for the beginning of our next session in 2 weeks.
Yes, I think that's a great idea. Thank you so much. So we do have a question from Carol. Are narrative assumptions the same as budget justifications?
It's a great question. The terminology, I think, is very, very similar. Budget justification is often, however, an explanation of why you need to budget something new. You're looking to expand a particular program or buy a new item. Well, for example, perhaps you think your conference room needs new conference chairs. That really isn't a budget narrative. That's budget justification. We have very old chairs in our conference room. We are concerned someone is going to get injured if one of those chairs let go. Now, that may sound silly, but I think we've all been there. Where budget narrative is much more around assumptions. I am assuming a certain level of turnover. I am assuming I will have 4 volunteers that will continue to support my department next year. But what if that changes? Those are more narrative assumptions. So I hope that's a good differentiation.
Thank you, that was very clear. Any other questions? Remember, you can raise your hand and we will unmute you.
We have one question.
Sure.
Are there specific Medicare or Medicaid rules about budgeting? There certainly are. And for anyone who is a Medicare provider, and some of you may well be Medicare providers, I'm certain you're used to working with the finance professionals in your organizations and hear about Medicare requirements of particularly how restricted funds are handled in the financial management process. Restricted funds, probably the best example of that, are grant funds. Those grant funds have restrictions, and they have to be handled in a certain way, not only for the grantor, but for Medicare, Medicaid, and the rules they have. There are many, many, many accounting and finance rules by the federal government, which is both Medicare and Medicaid. So great question.
Well, we are coming to an end. So I just want to thank all of you for joining us today. And I encourage you to join us again on October 17th for our final session in our final series in our webinar. And also we will be deploying our survey, so please just take a few moments to complete those questions, and we thank you again for those who participated previously. Thank you so much and have a great day. Thank you, Dr. Arsenault.
You're very welcome.